welcome. You're watching Budget of Hope, an initiative by ICICIdirect.com, and I have a special guest with me, Mr. Pankaj Pandey, Head Research, ICICI Securities, to talk about his expectations from the Budget 2021. Welcome, Mr. Pandey.
Thank you, Geet.
Mr. Pandey, there was a recent statement by our finance minister, and I quote, "I want to see a post-pandemic budget never seen before in 100 years. Expectations have increased from her budget this time. Mr. Pandey, what do you expect from the budget?
Last year, if you look at, was a very eventful year for the markets. So we had this COVID crisis, and compared to 2008, 2009 financial crisis, this is twice the kind of a problem we faced. And as a result of that, the overall GDP is expected to contract by 7 to 8%. And fiscal deficit is expected to rise by 7%. So union budget is a very important event this year, as it would display the measures which the government is going to take to address the broader challenges which the economy faced post-COVID. And our sense is that government is going to focus big on infra and manufacturing. Manufacturing, they have already come out with some details, but we would expect a more finer details. So I think overall macroeconomic conditions are quite conducive for a big infra push, which I think will shift our economic growth to a new orbit.
Mr. Pandey, flavor of the budget has to be capex. And do you think government has much room to really deal with all this? I mean, you have to push growth and you need capital expenditure. Private investment is nearly zero.
Correct. So this year, the fiscal deficit is expected to be about 7%. And our sense is that government would for some time ignore fiscal prudence and focus more on growth. So for next year, we expect fiscal deficit to be about 5%. So that gives an extra leg room of about 3 lakh crore to the government to push for infra. See, last year, government has unveiled a national infrastructure pipeline of about 111 lakh crores. So if you sort of split that into 5 years, every year you're looking to spend somewhere about 20 lakh crore on a yearly basis. Now, last year, because of COVID, things did not sort of pan out. And our sense is that the infra capex is down nearly by 25-30% this year. So to recoup that ground, the government will keep the fiscal deficit high and will look for a big push on the infra side. And you will have various sub-segments which are expected to do very well going forward in that.
So what is the fiscal deficit target that you see for FY 2021-22?
So we have penciled in a fiscal deficit target of 5%. So largely, that's a sort of a worry for a debt market, but for an equity market, I think equity markets are going to sort of like that kind of a number, because the need of the hour is to sort of spend more on infra, more on jobs which will be both skilled and unskilled. So from that perspective, I think infra push is something which is very much on the cards. I think the extent of spending is what we need to sort of figure that out. And I think beside that, manufacturing is another sector which the government has clearly sort of put it across. So they have already identified 13-14 sectors, and incentives are expected to be given to the tune of about 2 lakh crore. I think we'll get some more finer details, and along with that, tweaks in custom duties and import duties to benefit more of domestic manufacturing in these segments.
Anything big that you think will be announced to boost private consumption?
So my sense is that infra and manufacturing would have a multiplier effect on the overall economic growth. I think on the personal side or corporate tax side, I really do not think that the government will have much of a headroom. So which is where we are not that hopeful that on the personal side probably to some pockets like MSME, wherein the government might extend the interest subvention scheme. Otherwise, largely, I think with the government finances already tight, my sense is that the focus again will be on two big things, which is infra and manufacturing, because that will sort of lead to the overall economic revival. So I think that will be a bigger focus area. in case if the GST numbers are good, so for example, last GST collections were quite good. And what we have seen is that GST collections usually sort of normalize after a pain of 2 or 3 years of implementation. And if the government is able to increase the tax to GDP ratio, which is what was expected prior to GST implementation, that it will sort of go up from 17 to 20 odd percent. I think that if the government is confident of GST numbers going forward, which is what we need to sort of look in the budget, then probably something on the personal side or to boost personal consumption can come up. But I think from a personal consumption perspective, our sense is that probably some more finer details on scrappage policy probably could come out. That might sort of lead to some bit of personal consumption of certain categories. Similarly, I think our sense is that tourism also is a sort of a big sector, both from employment generation perspective and overall economic growth perspective. At least some of the global economies have displayed that very well. So besides infra, which also sort of benefits tourism as a overall, probably some kind of a scheme which US has also come out in terms of some spending tax deductible expense to be allowed if people are traveling domestically or spending on tourism domestically through GST notified operators. I think that might something which can be worked out or can be there in the budget.
There's a miss on disinvestment target, 2.1 lakh crore of target, and till now we have seen around 15,000 crore of mop up from disinvestment, and it is expected that it should be somewhere around 40 to 50,000 crores towards the end of this current fiscal year. So what is your expectation on the disinvestment front? You have a large pipeline, LIC, Air India, but nothing is really materializing.
Yeah, on the disinvestment front, we expect that the government is obviously expected to sort of miss their numbers this year. But next year, we're quite hopeful that the government will be able to achieve a lot more, largely because the domestic liquidity conditions plus global liquidity conditions are expected to remain buoyant. So, and overall market trajectory also looks good given the broad-based recovery what we are seeing. But we have, or I would not sort of hazard a guess in terms of numbers, largely because for some of the big IPOs like LIC, government has appointed a valuer, so the value needs to be identified, and subsequent to that, something can get materialized. So it's a sort of a number which we'll have to sort of look at in the budget rather than sort of hazarding a guess at this point in time.
Let's talk about the health sector. After COVID crisis, health sector should be in focus in this budget. What is expected for this sector this time?
So healthcare is something where we've been sort of underspending for a good period of time, and compared to whether you look at global metrics or even within BRIC countries, we've been spending a lot more lower. But our sense is that in this particular year, because of COVID, the government is going to take a number of measures. So overall allocation for healthcare is expected to increase by 49%, so roughly 50 odd percent, to about 1 lakh crore. And so especially to sort of improve the rural and urban healthcare infrastructure. Besides that, our sense is that the government is going to spend nearly 24,000 odd crores on the vaccination drive in the first half of this calendar year. So from that perspective, healthcare definitely is expected to be another big focus area for the government.
And what about the agriculture sector? Can we see some bold steps in terms of agricultural reforms?
I think Farm Bill is already on the being passed, and our sense is that if you have to sort of look at a broader picture, typically the challenge in India is that the entire value chain is sort of choked. I think a good example of what can happen in farm sector is you need to look at the dairy sector. So in dairy sector, the realization to end farmer is nearly 60 to 70% of the overall market price. Whereas in a lot of other agri commodities, because of various constraints, whether it is warehousing, whether it is the quality of seed or other stuff, the realization to farmer at the end level is only 20-30 odd percent. So if you are able to sort of improve the value chain, then I think the benefits of this is going to be far more longer. But we'll have to see how this sort of pans out, because there's a sort of a political issue now at this point in time. But we're quite hopeful that the government will be able to push it through over a period of time, because that will be a sort of big game changer to the overall agri GDP, which has been sort of languishing in single digits for quite some period of time.
Can we expect some kind of a fiscal stimulus for the hard-hit sectors like aviation and hotel and tourism? Can we expect something to happen for them? I mean, it has been long in demand.
So I think tourism, largely, if you are sort of looking to develop airports at top 100 cities, increasing the port capacity, looking structurally to sort of kill the overall crime rates, I think that's a sort of a far more structural posture. I think specific to sectors like aviation and hotels, my sense is that they would, though they need it, but they would really not sort of find favor from the government, given the fact that largely the public perception is still that these are sort of luxuries for from an overall social perspective. So which is where I think despite needing it, they may not really get it, but government might sort of do a lot more structural steps, so which may not be sort of beneficial in the short term, but over a longer period of time, yes.
RBI has very well managed the rupee, if we say, but if we see the international crude prices are on the jump again. I mean, it's near $55 per barrel. Do we expect some kind of an excise duty reduction for petrol and diesel in the current budget? Because now the petrol is ruling around 99, 98, and diesel is also, just 5 rupees down the petrol prices. So can we expect excise cuts?
So surprisingly, I would not expect any sort of excise cut in both petrol and diesel, largely because I think it's a good way of financing the deficit what the government has been. So at $60, we nearly sort of spend about 8 lakh crore in sort of buying crude, and it's a very sort of a important revenue lever for the government, both for the center and as well as states. And my sense is that going forward with the perspective that the government would want to push more of greener vehicles, the taxation on the IC engines across categories is not likely to come down. So from that perspective, I don't see much of a relief sort of coming there. But yes, like I've said, in case of say PLI, the government has come out with say 51,000 crore kind of allocation for domestic manufacturing of batteries plus other components. So that is where I think the government is going to sort of push more. We have clearly seen that in the thermal power, despite whatever push, the government has been sort of pushing for green energy. And I think given the overall environmental concerns which are sort of prevailing in key cities, my sense is that they are not going to come down or cut rates on petrol and diesel, if not increase. So that way, I think structurally it does not look like you will see prices coming down. If globally prices come down, the government might increase the excise duty, which is what they've been doing up till now.
Okay. Long-standing demand from auto sector, cut GST from 28%, and the scrappage policy. We might hear on scrappage policy in this budget. What about the GST rates? Do you expect some kind of an alteration in those rates too?
So for IC vehicles, I don't. But I think government might allow some exemptions to foreign players who are sort of going to set up shops in India, because the import duties are quite heavy, even for components for electric vehicles. So somewhere down the line, my sense is that the government is going to lean more on the electric vehicles rather than sort of IC, whether it is a two-wheeler, four-wheeler, or CV. I think CV, they have already announced some measure, but I think that is sort of not enthusiastic enough for the markets. But if they come up with some concrete policy on the overall scrappage policy, I think CV commercial vehicles will be the most will be the biggest beneficiary of those measures. So from that perspective, you have selected players which are expected to benefit a lot from this, because our sense is that probably it could drive 30 to 40% of the incremental demand if the scrappage policy, which is what market is expecting, comes through. But let's keep our fingers crossed.
Similar demand is from the cement sector also, cut down on the GST from 28%. Would government listen to them this time? I don't think so.
I totally agree with you, largely because I think the government has been wanting lower prices of steel and cement for quite some time, because these are sort of basic input for infrastructure building. But I think with the petcoke prices also going up, it does not look like that you will see prices coming down. And my sense is that the government is not really going to sort of cut that. Probably they could sort of incentivize real estate as a sector, say for example commercial real estate, wherein probably they could give an industry status to them so that they can raise funds even overseas also. But largely it does not look like that the government is going to cut duties, especially in cement.
Bank recapitalization, do you expect something coming on that?
My sense is that, while the government will keep recapitalizing PSU banks, but I think structurally what the government would want is that more private sector participation, and which is where my sense is that you would look at industrial houses being given banking license. Because while bulk of the market cap resides with top 3 or 4 players, but the most of the advances are still with the PSU banks. And every crisis, because of PSU banks asset quality concern, the overall economy also suffers. So my sense is that one way to sort of hedge this cyclicality is to sort of give more licenses to big industrial houses, because they will be able to raise money more efficiently, deploy it more efficiently, and in that process you will de-risk the system. So even if they are giving money to PSU banks, I think from a market perspective it does not really help much, because you will keep diluting book or below book. Most of the PSU banks are trading below book values. SBI is now sort of come to one-time book. So the challenge still lies. I mean, if you are in banking, I think if you ironically look, the most expensive banks or NBFCs have done even better. Largely because as a business, you need money to be raised at regular intervals. So if we can sort of raise money with less of a disruption or less of a dilution, I think that's good for from a shareholder perspective.
But last time, as in the budget too, there was talk about privatization of the PSU banks, but nothing has happened on that front. Will that really help, and will they be takers for these PSU banks?
So I think it remains to be seen, because Bank of Baroda, we had seen that experiment wherein the top positions were given to private individuals. But I think it is very difficult to change the culture in PSU banks at the bottom level. So, which is where I think to sort of transition a PSU bank to behave like a private sector bank is a long task. And which is why you would not want that to sort of hamper the growth of the economy, and which is why you would want more efficient private players to sort of come into it. So till that time, the government will keep capitalizing PSU banks, though not good for shareholders, but that's the reality.
Right. Bad bank story is back. Can we expect a bad bank for PSU banks this time?
So it can be, but I think largely if you look at, we are behind our peak asset quality cycle. So you had 13-14% of the peak NPA which had come by. And from that perspective, probably this COVID can add another 4-5% odd. So largely we might sort of go back to those levels only. But I think probably it's a sort of a late idea or to sort of implement at this point in time. Had it been done 3-4 years back, then I think it would have been far more beneficial. But largely, I think a lot of asset, restructuring and resolution is already sort of manned out. So from that perspective, I think it's a sort of a good idea, but the timing is a bit late.
IBC is nearly dead. I mean, it has been postponed. All the cases which were supposed to go to NCLT have been postponed till 31st of March. What is the fate of IBC? Do you think something would be announced as giving more teeth to IBC, or for certain reason they'll just say that okay, IBC is not working, let's shift to something else. I mean, do you expect something like this in the budget?
So, not that I have an expectation from that perspective, but yes, what you're saying is also right. So this is not something which we think that probably might be a sort of a center of attraction in terms of budget. But yes, I don't think that I'm going to hear much on this front.
Nothing much on this front.
Yes.
Okay, from contraction to IMF saying that we'll grow by around 11 to 12% in FY 21-22. So what is expected? I mean, what is the target that you set for GDP in the current in the coming fiscal?
So we are expecting that the real GDP growth rate could be about 10% and nominal GDP growth rate could be about 15% next year. But then again, I think that's a sort of a normal trajectory which we have taken. But if the government chooses to sort of push this lever up, probably the growth rates would be even more better. I think what we also need to figure out is that since rupee is sort of stable and it looks like that the RBI is going to sort of keep the rupee stable. So that is also going to help in terms of a lot more fundraising overseas also, because rupee volatility is something not good from a fundraising perspective, and especially if you have to sort of do a lot more capex. So from that perspective, I think rupee is likely to be sort of made more stable, less volatile, and fundraising is what I think needs to be sort of done. And mind you, with kind of interest rate which are there, overall, I think again, capex looks a very sort of a bright spot for the government.
Coming on to markets, what do you expect? How do you expect the markets to really be? Now we have seen a set of correction from last 4-5 days. There has been a correction in the markets. So do you expect the correction to go further, or you stabilize around current levels?
So the way I see it is that from 80-85% kind of a rally, we have seen about 800 points kind of a correction, or 5% kind of a correction. So 5 to 15% kind of a correction is pretty normal in a scenario what we have seen. Our Nifty target is about 16,200 levels, so which is a sort of a bottom-up calculation which we have done, because the constituents in Nifty is changing and market typically is more forward-leaning than backward-looking. So from that perspective, our sense is that with the kind of constituents which are there in the index and the kind of commentary which has sort of come out, we'll see a lot more better growth rate for the Nifty or index, and that will sort of get reflected in the valuations. And on top of it, the liquidity conditions both domestically and globally look quite attractive. So I think that way we would not expect any derating of multiples from that perspective. So I think this is a healthy correction. Market is sort of getting lighter ahead of the budget. It's a good buying opportunity because we have not seen, so while the correction is there, mid caps and small caps are still holding relatively well.
3 sectors that you would focus on for the budget event.
So the only sector from budget perspective which I'll focus is infrastructure. But for the year, if I have to look at, then IT and pharma, clearly 2 sectors which are going to sort of do substantially a lot more better because of structural better growth rates. In addition to that, this year is going to be a year of mid caps and small caps, because they are going to do relatively a lot more better growth rate. So there is a scope for margin expansion, better growth rate, and multiple expansion as well.
Thank you very much, Mr. Pandey. It was a pleasure talking to you.
Thank you so much, Geeta.